let me start with the case for a chat today before I introduce our guest on the show. The case for a chat, and you can argue that one of the things would be around whether financialization of savings will impact deposit growth constructively. Are we seeing signs of that already in the Q4 numbers thus far, because of which banks are taking center stage in holding the markets higher? We also need to focus a little bit on consumption since some of those things have started trickling in, and whether discretionary spends will aid consumer services going ahead. Lastly, are healthcare valuations pricing in some good delivery from the healthcare space, or will we see some uptick out there? Well, I think on all of these points, the portfolios of Helios, AMC seem to be perfectly placed, and therefore we get in Dinshaw Irani, or we talk about these points to Dinshaw Irani of Helios Capital Management, joins us right now on the show. Dinshaw, great having you. Thanks for taking the time out. I would have wished for the Bombay traffic to be better, for us to be sitting across face to face, but nevertheless, it's great having you.
Thank you, Niraj. Thank you for having me on the show. And sorry, I would have loved to come across to your studio, but there was a mess-up. So
Completely agree. But Dinshaw, it seems like the market is not seeing too many mishap. Almost every wall of worry is being climbed. And while I've seen enough people talk about the issues, you guys have been out there saying that you are constructive, you continue to remain constructive, and it's paying off thus far.
Yeah, Niraj, actually, so look at the medium and long term. I mean, obviously, nothing can be parallel to what's going to happen to India. And probably you can draw a parallel from what happened in China in the early 2000s till the 1819s, as such, 2018, 19. I think that's what India is going to go through. Right? But because, I mean, why? Because we are looking at the economy growing. We're probably going to be adding probably a fifth or a fourth to the delta of GDP growth every year in the next 5 years as such. So obviously it's going to be an exciting time going forward. And we're going to be the third largest economy and stuff like that. Yeah. But in the immediate short term, we are a bit more cautious than what we were earlier, though we remain constructive on the market. But in the immediate short term, I think there are quite a few bumps along the way which we need to overtake before we get totally bullish. So I'll leave it here.
Yeah, but so I'm wondering, Dinshaw, what is the mental model while putting in money to work? Because you can argue that, yes, on the valuation argument, people are not wrong. It is, to an extent, expensive now. So therefore, do you look at past instances of other economies to tell yourself that, Baba, earnings growth will make up for this?
So Neeraj, it's not only valuations. Valuations can remain stretched for a very long time, but they need some negative triggers to correct, right? And I believe, I mean, that's what we believe is that starting from the March quarter, the numbers may not be that exciting. I mean, our feel is, though you saw what Voltas gave out, and it's put the whole AC market on fire as such, but our feel is that's more of a push towards the inventories being held by the distribution chain rather than actual offtakes happening, because North wasn't that exciting in terms of AC. But anyway, putting that aside, the fact is that there'll be pockets of disappointment in this quarter. And obviously that will be one trigger that probably the market may not like as such, given that the last 6 quarters prior to the March quarter, one has seen only upgrades happening in the earnings of the Nifty and various companies. Our feel is this time around the disappointment to surprise ratio will be more of even Steven rather than in favor of surprises. So that may be a dampener. Then comes the elections right around the corner now. Obviously, a lot of rumors will fly around that time, so markets will be fairly volatile and choppy. And then comes your budget. Again, the budget will be quite a few rumors flying around already about the budget, and obviously there are good things and bad things being heard. So the markets again will be choppy. And the last one would be, I think, interest rates. Our belief is that the market has jumped the gun on that. We do not believe the interest rates will be so easily cut this time around. I mean, and obviously the trigger will be the Fed. The Fed will have to lead the cut on interest rates as such, because other economies are just about trying to manage their rupee, not rupee, the currency vis-a-vis the dollar. And so is the case with India. And looking at what's happening in the US, the service inflation is a problem there, definitely. So it's obvious that the Fed will not be too keen on cutting in a real fast pace. So one has to wait out these small bumps along. And one more thing, Neeraj, I would like to highlight. I mean, today there was this news about two top guys of two companies quitting, and the stocks are up. I mean, one stock is like phenomenally up, the other one is not up. Sorry, one is down. But the one stock is up because they said that, okay, the top guys. Now imagine the top guys quit at the turn of the quarter. Obviously, there's been a problem with the quarter, and that's why he's quit. Why should that stock be up? I'm not talking about Bandhan Bank, which you flashing just now, I'm talking about the other guy. So I'll leave it here. So there's obviously, as you said, that the market is climbing all walls of worries, and some of them are irrational, I suppose.
I'm glad you mentioned that because Wipro finally is also now coming off. So it was started off high and now it's in the red. So keep that in mind as well. During the course of the day, Wipro slipped into the red too. But point well taken, Dinshaw. So let me start off and talk about some of these. I'll come to financial services in a bit. You guys have a high overweight there. But consumer services, how do you dissect? You spoke about how AC sales were good some place or the other, but the numbers from a Voltas, for example, very strong. And I think we've seen that traction happening in Symphony and some of the others. We've seen some of the other discretionary plays, be it watches, be it cars, etc., do so well. And the commentary from staples may be better than anticipated, Dinshaw, but not quite up there. So how do you straddle the two ends of the barbell? Do you keep overweight on what's worked thus far, or do you go for staples which are probably better relative to the valuations that they've enjoyed in the past?
So, Neeraj, I mean, I think the biggest red flag was given out in the last quarter itself. I mean, if you guys remember, the top line growth wasn't that exciting. It was mainly the margin expansion which really aided the growth in profits, and that set us wondering. I mean, in fact, if you again, if I go back to that quarter, the end of season sales in started in December itself for that quarter. So obviously, it's obvious that things were not looking that perky in the consumption space, and that's why the EOSS started far earlier, probably like 3-4 weeks earlier than what was. So there was an inventory build up and already happening. So that set us off, and we started becoming a slightly more cautious. So as you rightly mentioned, I think discretionary is a space that you want to be cautious on. Staples, probably, I mean, with a mid-single digit, most of the guys who reported thus far are either low single digits or mid-single digits. I'm talking about domestic growth here because some of them have also international exposure. But looking at their domestic growth prospects, they're not that exciting to command P's of 50 and 60 times forward earnings. So we are more of cautious out there. Overall, in the domestic space itself, we are fairly cautious. We're looking only at the luxury part of that space as such. So high-end cars and stuff like that is what we're looking at. And that's why we're being fairly okay on that space. Otherwise, consumption per se, probably will wait it out for a couple of quarters. As I said, there are quite a few hiccups to go across, and probably wait them for them to pan out before looking at that space once again very constructively.
Okay. So this 10.9% weightage in consumer services for the flexi cap fund at least is centered around what, may I ask? I mean, what part of consumption therefore?
So basically, we're talking about somewhat a QSR, we're talking about luxury spends, we're talking about some, but QSR we're not too bullish on right now. I mean, we're just holding on to what we have. And obviously, a lot of stocks in tourism and leisure.
Got it.
So that is what we're looking at. So.
Okay. Yeah, QSRs have had a bit of a rough ride off late. I was wondering if the IPL and other things put together kind of bring about a bit of a zing there or no, but remains to be seen. Okay. What I also found interesting, and there's a bit of a pickup there or a proof of the pudding there, is healthcare. And at least, I mean, last week, a clutch of these API companies ended at the highest levels that they have ended at. Some of the others are seeing traction. Within healthcare, where you have a 9.5% weightage, if I'm not wrong, as per the last release, and maybe that's changed a little bit, what facets of healthcare interest you, Dinshaw? That space is starting to perk up a little bit now.
So Neeraj, good you asked that question. So we have this lovely model for rather rejecting stocks. It's called elimination. It's called elimination investing. And what happens in that is that whatever comes out of the funnel is what our manager is obviously going to look at. And so off late, by the way, the two factors, there are 8-factor rejections which go through. The last two factors are the ones which are really gives the freshness in the portfolio. And one of them is medium-term triggers, and the last one is valuations. So on that basis, quite a few healthcare stocks started coming out of the funnel as such. And that's when we realized that something's changed here. And obviously, the change was what was happening in the US, because the pressure that these fellows were facing earlier in terms of the pricing and all had gone away a bit, and the inventory destocking had come to such a critical level that there was restocking happening. So it was obvious that the growth rates are looking very exciting. So we are mainly now looking at not only the domestic plays, which we've always been bullish on, because as I said, if economy is growing, healthcare spends are going to grow. And obviously now even the US focus pharma companies are coming into the portfolio in a way for us. So I think that explains it all, why our healthcare has moved up, the weightage has moved up.
Okay. Just before we take that break, Dinshaw, though, based on all the rejections, etc., and stuff like that, sorry if I missed it, but what facets of healthcare? I mean, are you changing the tack on maybe APIs, CDMOs, etc., or are you sticking to what's worked thus far?
So as I said, Niraj, in
Sorry, I
fact, we
missed
were
it,
very
yeah.
clear. No, that's all. So we were very keen on domestic pharma companies, right? And that remains in the portfolio,
Okay.
that weight remains. But we're also now getting more bullish on the CDMO space, the API space, and obviously the generic filing space in the US and stuff like that. So that's where we're getting bullish on.
A big upgrade came in for Infoedge this morning from Citi, and Nomura too kept its spirits high. A quick update from Puneet, my colleague, on what these reports are saying, particularly Citi, and why so. Puneet.
Yeah, thanks for that, Niraj. So let's start with the Citi note, which has given a double upgrade to Infoedge with a target price of 6,650, which is roughly a 17 to 18% upside from the current levels. Now, they say that the recruitment business is finally showing some growth and is up 7%. The billings for the same is up 7% year on year, versus a flattish revenue estimate. They say that the recruitment business has likely bottomed out on slowdown in the hiring. So they see that the hiring in the IT sector should be going upwards from this level. They've also raised their estimates as well as expect EBITDA for the core business to rise 8% each for FY25 and 26, and they've given also taken the new target price of Zomato in the SOTP calculations as well. Finally, for the core business multiple, they've increased the multiple from 36 times to roughly 42 times, and they've arrived at the SOTP target of roughly 6,600. Quickly just covering Nomura note as well on Infoedge. They maintained a buy with a target price of roughly 6,210, which is roughly a 10% upside from current levels. Apart from the same points on the recruitment businesses, they've said that slowdown in the IT sector has finally bottomed out and see a good growth in the future. The 99 acres billing also grew 26% versus an estimate of 24 to 25%, while other verticals such as matrimony as well as education have shown good growth and grew roughly 14%. Overall billings up year on year at 10% versus an expectation of roughly 6%, and that's why the target price of roughly 6,200 from Nomura on this. Back to you.
Thanks for that, Puneet. Okay, and Dinshaw, here's the question. I mean, some of these tech businesses' belief was that IT hiring is going to be very, very tepid, and nobody anticipated anything. Suddenly, Infoedge comes up and says, "Hey, our billings are okay." Some of these, then I think the valuations for Zomato have been upped as well by multiple brokerages. They are taking that into account. We saw PB Fintech recently, after being in hibernation for such a long time, suddenly come up to the fore. Save for Paytm, I think some of the others seem to have gotten their act in execution and otherwise right, and now are starting to see the benefits maybe?
Basically, what the stocks that you mentioned are mainly the platform guys, right? I mean, and in fact, we've been quite bullish on all these platform companies. They may be classified as IT, but actually they're real platform providers. I mean, in terms of, say, fintech, or in terms of employment, I mean, avenues and stuff like that. I mean, I'm talking about this thing. So that way, and obviously delivery and hyper delivery, hyper local, and food delivery and stuff like that. So these are the companies that we've always been bullish on. So we've never been fairly worried about their potential. They're domestic focused companies. They're providing solutions here. The employment generation company, I mean, I'm talking about Infoedge that you mentioned. Basically, 7% growth YOY is not exciting enough for those kind of valuations. I think the valuations are coming mainly because of Zomato out there, the way Zomato has moved up, and some of parts is building in quite a bit of value there. But one more thing, I mean, Paytm, I mean, Info, if I remember right, bulk of their the recruiting business used to be via for IT companies. If I remember, it was like almost 50+% at that point in time, which got reduced to an extent. But I mean, if I read what the IT guys are telling or are mentioning in the press, it's obvious that they're trying to load up on employees right now in terms of searches and all, and they're keeping their databases live so that in case there's a pump up in the spends, they can start recruiting people. But it's not really classified into action today. So maybe that is what is playing out in Infoedge, apart from anything else. But however, we of the few companies you mentioned, we're more bullish on the hyperlocal delivery part of that business. So.
Okay. And just a quick update, Dinshaw. I mean, the ones who've not quite gotten it right because of various reasons, right? I mean, Paytm, etc., case in point, and you guys were bullish at a point of time. Better to weed out the losers and move into something, or would you keep the faith?
No, so Neeraj, we're keeping the faith with Paytm. We haven't added to the name. The reduction that you saw was in the weight was mainly because of the price correction rather than us proactively cutting weight as such. We wanted to initially, but the way that savage move happened downwards, we realized that there's no sense now selling out the stock. We are fair believers in the kind of platform Paytm has created.
Okay.
And frankly, I mean, we would rather wait for the sound bites to clear out before taking a very constructive view on that particular stock. Right now, it's too fluid for us to even take a call on that stock.
Got it. No, fair call. Fair call. Okay. The other piece is your belief in financials, right? And to an extent, you would be happy with the quarterly updates that have come out thus far. I mean, most, if not all, including what's happened to the larger ones like HDFC Bank, have come out with what I thought were pretty decent updates. Do you think this is the start of something meaningful in terms of business growth?
I think so too, Neeraj. In fact, if you remember our last few meetings that we had, I mean, the interviews that we had, we were very clear that it's a matter of time before strong franchisees start kicking in on a big way. Obviously, HDFC Bank had its own hiccups initially. It started with the change in the top, then came about the ban by RBI on the credit cards, and then obviously the platform issues that they were having in terms of the technology platform. And then the last one was the merger, which happened, which obviously took a while to standardize, I suppose, I mean, get the digest rather. So it's obvious that now things are in place there. And the way that growth happened in this data, it also took us by surprise, by the way. We weren't expecting such a huge kind of deposit growth, but one can really appreciate that the kind of franchise that bank is. And obviously, if you see the other private sector banks also, which have reported numbers, it's come out pretty obvious that there's been a definite growth in terms of deposits for all, but the way HDFC grew, it was like a phenomenal one for us. So that way, but yeah, we continue to be bullish on that sector. We continue to be bullish on strong franchises. In fact, even in the PSU space, we have a few which we would call strong franchises, and we continue to remain invested in this.
Okay. Just wondering, would you, I know you guys are not constructive on IT and maybe with the right reasons, right? Samir mentioned that in detail. I'm just wondering if Naukri's billings, which is up 7%, are an indication maybe that IT companies might be hiring. I don't know if they are. Frankly, as of now, it doesn't seem like Accenture numbers lay out that there is nothing happening on the anvil. But if indeed Indian companies' hiring numbers pick up, is that a precursor to positive times, or you would wait for some time?
So Neeraj, actually, I would rather wait. I would rather wait for the numbers to really figure out, because as I said, I don't think the numbers which the hiring numbers, actually it was not hiring, it was mainly the revenues of Infoedge that doesn't justify no hiring. You can apply, you can refresh your databases, and you will pay Infoedge for the same as such. So it's obvious that things are moving there. And I think it's all in hope that things will pick up probably in the second half of this calendar year. But frankly, I mean, whatever sound bites we've heard or whatever calls that we've done, we're not seeing too much of bullishness in that segment. And as I said, the top guy in one of the big IT firms quitting at the fag end of, rather the beginning of a new quarter. Obviously, the last quarter wasn't that great, and that's why he was asked to leave. I suppose I'm just speculating out here. I don't know what really transpired, but that's the feel that one gets. But the fact is that obviously, if the quarter was good, he would have continued to stay on as such. So it's obvious that there's some problems in this quarter. It's not looking that simple a run for IT as such. And obviously, I mean, if US is looking at probably interest rates getting postponed, that story again dies out of discretionary spends kicking in, which are really the margin movers for IT companies. So it's obvious that things may not pan out as I think everybody expects it to be. So we'd rather be cautious today and stay away from that sector.
Okay. Well, we've discussed the heavyweights today with Dinshaw Irani as opposed to going into the minutiae, but for maybe QSRs a little bit. But it's great to get that view at the start of the earnings season. Dinshaw, thank you so much for taking the time out and looking forward to having you in the studios the next time.
So Niraj, one more caveat I would like to give out that whatever negatives we talked about probably will be short in our advisory portfolio. Wherever we're positive, we'll be long in our portfolio.
Yeah, and viewers, please do your own due diligence. Do not take anything out here as an advice for buying or selling. You have to do your own thing. They may change their view tomorrow, and that can happen. So please keep that in mind. Dinshaw, but thank you so much. Much appreciated.
Thank you. Thank you, Niraj. Always a pleasure.
Likewise. And viewers, thanks for tuning into this edition of The Talking Point.